Hello people, this is Harsha and welcome to my channel. I make videos on education, career, lifestyle and most importantly on learning. My long-term vision is to expand the curiosity and consciousness in the field of education so that we all can become the change makers of the country. So let's get started. In this video, I would like to explain you a simple topic called the intrinsic value. The intrinsic value. Simple topic and every stock market enthusiast must have definitely come across the term intrinsic value. In the stock market, especially, there are companies having share prices. So, before understanding intrinsic value, you should understand why is there a need for intrinsic value. Everybody in the stock market who is putting in their hard-earned money or money is worried about one thing. My share price goes up or goes down. Yes or no? When the share price goes up, he is not worried. Why? Because he's happy. When the share price goes down, he's worried. Why? His money is getting into trouble. But there is a point where the share price is at its fair value. For example, there is HDFC Bank. There is HDFC Bank, and it's trailing at, for example, just say 1600 rupees. Right. And now Mr. X has bought HDFC Bank at rupees 1600. And on next day, immediately, HDFC Bank share price fell by 5%. Now, Mr. X gets into very good trouble. Why? He invested in HDFC Bank at 1600. Immediately 5% fall. He would be very much into trouble. But there is Mr. Y who invested in HDFC Bank long back at rupees 1250 rupees. Let's say 1250 rupees. Now, even though there's 5% fall the next day, he would still be in profits. But Mr. X, who invested yesterday at 1600, saw a loss in his portfolio. That is why, even though the company is good, even though the market is good, you have to choose the right price. If you're not choosing the right price, then there would be a problem. Why? There's a particular house, let's just say in Delhi or in Visakhapatnam too. Okay, there is a house in Delhi, there is a house in Visakhapatnam. Both have got different attributes. Why? It is in the top area, it is also in top area. Now it has got 3 bedroom, it has got 4 bedroom. Okay, and this is trailing at a price of 2 crores and this is trailing at a price of 50 lakhs. 50 lakhs. Now, on comparing the houses, and if I pay 2 crores for Visakhapatnam house and I say I got a good house in Visakhapatnam, that would be foolishness. Yes or no? That would be foolishness. Why? The value is worth 50 lakhs, but you're buying it for 2 crores is not commendable, especially in stock market, even though HDFC Bank, which is primarily a very good bank. Now, I'm telling you, this is not any recommendation or this is not any special interest on HDFC Bank, just an example. But as having said that, HDFC Bank is really a good bank. Now, HDFC Bank is trailing at 1600, but after your analysis, it has come to a fair value of rupees just 1400. You have to wait till the value comes to 1400. Why is that? Because you can't buy a stock, you can't buy any product which is more than its value. Simple common sense. How many times you went to a supermarket, supermarket to buy vegetables, not the retail markets? No, we have it right. Along with your mother, you go, and what does there happen? There happens a bargain. There happens a bargain. They would say 50 rupees per kg. Immediately, your mother will say 20 rupees, 20 rupees. Afterwards, 15 rupees. You want that particular product at a very cheaper price. This happens in every arena, especially in the field of buying products like vegetables, daily consumables. We bargain a lot, but we don't do in stock market. We learn it, but we don't apply it. Why? Stock market is a game of emotions, and we have something called FOMO. And because of FOMO, we forget basics that we have to buy a particular price at its fair value. That is why we need to understand the concept of intrinsic value. Intrinsic value. Intrinsic value is nothing but deriving, deriving the company's original fair value. What is original fair value? Tomorrow, let's just say, let's say, let's name a company, Colgate. Okay, Colgate company falls by 5 percentage, right? It falls by 5 percentage. Do you think the business of Colgate also falls by 5%? Definitely not. The only thing that has really fell is because of the stock market. And stock market fall is not proportional to the company's performance, or stock market's rise is not proportional to company's performance. Therefore, one rule you have to understand forever in your life in stock market is that stock price increase is not proportional to company's performance. To company's performance. Of course, if the company performs quarterly well and the results are appreciated in the stock market and that are rewarded, then it's okay. But everyday movement is not linked with company's performance. It has got a lot to do with emotions, sentiments, daily news, fluctuations, other macroeconomics. There's a lot of other stuff, but it is not related with the company's individual performance. But if you derive a fair value basing on company's performance, then you get something called intrinsic value, and this would give you a direction. This is not the only method to invest in the stock market, but this would definitely provide a direction, a solid direction to help investors like us to take rational decisions rather than making decisions using somebody's interpretation or someone's logic or someone's emotional bias. This is the whole point of having intrinsic value in the game. Tomorrow, what happens? We don't know in the stock market. Definitely, we don't know. But if Nifty increases by 200 points and your portfolio increases by 2%, you will be very much happy. But you have to really understand at what price you really purchase them. You can't take a vague decision on this company is nicer. Let's just say uh, any company, let's say IIFL Securities. IIFL Securities. This company is a good company. For example, you assumed that this is a good company. Fundamentals are nice. Promoters are doing well. Companies' quarterly results are doing good. Annual results are nice. So you wanted to invest in the company at the trailing price. But if you analyze the fundamentals clearly, then share price is trading at actual share price is trading at 70 rupees, let's say, but your share price is rupees 45. Now there is a gap of 25 rupees. Yes or no? Someone who bought the share at 45 rupees has got a enough margin of safety than you. And this is the reason why we need to have an understanding over intrinsic value. At least it will give you a positive direction. So I hope you understood the reason why we require a concept called intrinsic value in picture. In the coming videos, maybe in the future I'll make videos on how to derive an intrinsic value of few selected stocks, and in coming videos I would like to make a deep analysis, like a quantitative and a qualitative analysis of a company, and thereon we can derive an intrinsic value. In the comment section below you can name the company. I would like to involve in that company and make a video and analysis on that. That would be a better suggestion or idea, I would say. So I hope you understood the understanding or the structure why intrinsic value is so important. Intrinsic value is a simple concept, nothing fancy. It is just deriving the fair value. That's it. You assess the company's performance, how it works in the long term, and you bring it to the present value, and you will derive a share price on your own. And mind you, every company has got different performance indicators. You can't do the same analysis for different industries. You have to use this information for different industries at different levels of comparison indicators. Right? That is very much important, and that is why basics are important here. You need to understand which ratio to be used for which industry in prior, and thereon you can make a comparative analysis. In that comparative analysis, you can make a judgment, and I can get a different intrinsic value, and you can get a different intrinsic value, and there is no harm in that, and there is absolutely no harm in that because intrinsic values in the end is an assumption based on your own ideas and your own interpretation on stock market and its development, not directly on the stock market, but how we are looking at the stock market, right? For example, if you are seeing that India's growth in the market is very good, you would put a different discount rate. You would put a different discount rate. You would have a different kind of understanding. If you feel that India is actually into a bull market, then you would have a different approach altogether for deriving the intrinsic value. So it is individual based, but deriving your own intrinsic value is a great exercise. Is a great exercise. Everybody should derive their intrinsic value and then only should have a positive direction over the company and its analysis, and then they can do the rest of the stuff. But this is not the only thing, but this should be the the most important aspect, I would say. Why? At the end, you are investing in the share price. A company might be so good, so good, but you are buying it at overpriced level, then you're automatically not making a good investment. That is the simple logic why intrinsic value should be derived. So I hope you enjoyed the video. I hope you liked the video. So please do like, share it, and subscribe. And in the coming videos, I would come up with good number of topics like this, and so that we can all become a good have we can have a good perspective over stock market as such. Thank you so much. Lots of love. See you and bye bye.